Well, we're going to go ahead and get started. We're 3 past the hour. Let me go ahead and share my screen here. And we're going to dive right in to the WIP. So our job today is to really go through and kind of describe in detail how the work in progress works and how how it pertains to project management and what their job is, and how it pertains to accounting and what their job is. And we're going to talk a little bit about how the project manager goes about doing their job. And we're also going to talk a little bit about how accounting does their job. So with apologies to you project managers that are in the audience, we're going to be doing a little bit of accounting today. So we're going to talk about those feared debits and credits, and with the intention of making you understand exactly why we're doing what we're doing and why what you're doing on your projections is so important to the company as a whole. And hopefully by the end of this session, you'll have a better understanding of work in progress from the perspective of the other side of the fence, whether you're on the project management side or whether you're on the accounting side. So our agenda today is pretty simple. The first thing we're going to do is we're going to go through the theory itself, which includes an overview of the work in progress, and which I call WIP without the H. And we're also going to do a earned revenue chart. After that, we're going to go through some of the basic terminology of of work in progress and exactly how that works. Next, we're going to go into what I call construction ops. So we're going to talk about the WIP from the PM side. Then we're going to go into what I call the accounting, and we're going to talk about the WIP from the accountant's perspective. All right, perfect. And it looks like we have the tradesman folk here as well. Welcome. Okay. We're going to go ahead at the very end. We're going to put together a mock P&L statement. And what we're going to do is we're going to show what happens to a company when you do a P&L statement without a work in progress schedule, without doing over and under billings, and what happens when you do it with it, so that you can kind of get a sense for how that works. I have enabled microphones for everybody. We just have a small group today. There was, like I said, 50 or so people signed up. It looks like we're less than that have been able to come today. So feel free and jump in at any time with your questions by just unmuting yourself. Also, you can use the chat and send me a message, and I'm going to have some time at the end to go through any questions that you'd rather I just go through on the chat. All right, let's go ahead and get started with our theory. Now, so the work in progress, the work in progress is an accounting method that matches our recognized revenue. It matches our recognized revenue to our earned revenue. And so it's an accounting method that matches our recognized revenue to our earned revenue, and it typically uses cost to do so. So I'm going to return to this later on because I think for those of you who are just kind of getting into this for the first time, that might be a little bit confusing. What do you mean recognized revenue? What do you mean earned revenue? But I can say basically right now, recognized revenue is the revenue that you show on your income statement or your profit and loss. It's the revenue that you say, this is our revenue for the month just passed. That's recognized revenue. You're putting it on there. You're saying this is true revenue. Earned revenue is a calculated amount that says how much did we earn on our particular project or on our projects as a whole. And earned revenue is a concept we're going to be introducing heavily in this class. So recognized revenue is what you show in your income statement. Earned revenue is what you calculate. And this accounting method, known as the work in progress or over into billings, matches those two up. So why do we do this? Well, the first reason, and I can actually say the most important reason that we do this, is that it forces project managers to look at their jobs and prove to the world around them that they understand the financials of their jobs. So when I'm talking about this accounting method, I'm actually talking about a full process that we go through every single month. And one of the most important things that happens in this is that we ask our project managers to give us a projection on their job. We're asking them to say, how much do you expect to spend by the time that this job is done? How much do you expect to earn in revenue by the time that this job is done? And if they're doing that every month and they're doing it reliably, then they understand their job better. If the project managers understand their job better, the jobs will do better. And it is that is our primary reason that we do this work in progress process in a company. We want our project managers to understand the financial impact of their job such that it gets better, because it's the jobs in a construction company that make the money. And it's our job in accounting or in the people who are preparing this work in progress schedule to help them make more money. Number two, the second reason why we do this, why we do a work in progress schedule in a company on a regular basis, it provides readable and therefore valuable financial statements to the managers and owners. So readable and valuable financial statements. What we're talking about here is we're talking about a balance sheet and an income statement. So we are providing readable, valuable financial statements to the managers and owners. That means that because of this process, we're going to have a profit and loss that we can actually trust. Because we have a profit and loss that we can actually trust, we can actually make good business decisions based on that, rather than having our business decisions based on bad information. So it's very helpful for the managers and owners. The third reason that we do this is GAAP, generally accepted accounting principles. That is, it allows our creditors, typically banks and bonding companies, to give us credit. So it allows them to look at our financial statements. This is often required by a CPA if they're putting together a reviewed financial statement or an audited financial statement for you. And it allows the banks and the bonding companies to look at your financial statements and compare them to others, and it allows them to lend credit to you. So they can either in the form of actual loans or in the form of bonds. You have to do this. But this is the third and the last reason that you need to do this. If you don't have project managers that understand their job cost, then your jobs aren't making money, and therefore you don't need to. You won't have a business to which you should lend money. Also, if you don't have managers and owners making good business decisions based on good, valuable financial statements, well, then same thing goes. So it is important, but the banks and bonding companies are third priority here. It's a happy accident that by doing this, we by letting our PMs, forcing our PMs to understand their job cost, by giving our managers and owners valuable financial statements, we also happen to comply with generally accepted accounting principles. So let's talk about this accounting method kind of at a high level. Like, what are we actually trying to get done? And I found that this is best illustrated on a little graph. So if we put together a graph, and on the x-axis we put time, and on the y-axis we put dollars, right? And let's just say that we have a real simple project that goes over the course of 3 months, right? It started last month in March. It went into April, and we expect it to finish up in May. And when we bid the job, we thought that it was going to cost us $120,000 to do the job. $120,000 it cost. And by the time we finish the job, we expected to bill the customer $150,000, right? People can generally do this math pretty well in their head, right? That means that we're going to have $30,000 of job profit. $30,000 of job profit. Now, to be clear, this is a little note that is useful to talk about here. We have $30,000 divided by $150,000, which means that we have 20% margin. If one of you guys that's here happens to be somebody that is in the estimating department, you might not talk about margin as much as you talk about markup, in which case this same $30,000 would be divided by our 120 here, $120,000. Hello, unknown participant, welcome. We have the goodbye. All right, and so then we have 30 divided by 120, and we get 25% markup. Right, 20% margin is the same as 25% markup. Those are the same things, but it just matters what the denominator is there, and that can be confusing. I like to just point that out at this time. All right, I usually talk about margin when I'm going forward, so I'm going to be talking about this job as a 20% margin job. Well, if this job is going to cost us 120 at the end of the job, one thing that that happens is that the cost comes in relatively smoothly. So especially if you're a labor-heavy job, then you're going to be then you're going to have every week the money just kind of trickles in, and it's going to have a relatively smooth cost curve. It's going to increase at regular intervals and just go up over time. So the billings, on the other hand, we don't have that same kind of regular consistency. We typically can only bill in chunks. So in this particular job, let's just say that we can only bill in 2 individual bills. At the end of the first month, we can bill $75,000, and towards the end of the job, we can bill the final $75,000. All right, pretty typical, 2 billings, 2 progress billings on a job, and the costs are coming in over time. Well, if we were to create a profit and loss statement exactly like this, what would we see? Now, for those of you guys who are familiar with accounting, you know that profit and loss statements or income statements answer the question of how much a company is making over a period of time. So if we would have 3 profit and loss statements, 1 for each month, right? And in this, we would have the billings of $75,000, and we would have direct cost of how much here? Well, it looks like it came in regularly, so we would have 33 here and 33 or plus 33 or 67 all around here. No, that's not correct. I'm sorry. I was dividing it 100 by that. It's actually 40, and 80. There we go. 40 and 80 at each of those times. So we'd have $40,000 in direct costs here, which means that we would have gross profit of $35,000. If we assume that our company has overhead of $20,000, that means our let's make that overhead a little cheaper for us, $10,000. Then our is that going to work? Make it even cheaper than that, $5,000. We'll make this a small company. Then our net profit at the end of this period, at the end of March, right, would be $30,000. Wow, $30,000. Okay. If we looked at the next month, then we'd put our billings in. Billings first. Let's go look. How much billings do we have in April? Turns out we didn't have any. We billed once in March and once in May, but we didn't bill in April. So our billings are zero. How much was our direct cost? $40,000. What was our gross profit? Negative $40,000. What was our overhead? Still pretty cheap, $5,000. What was our net profit? Negative $45,000. Not a very pleasant month. Then we get the next month, billings, right? Go up and look. Oh, we billed $75,000. Great. Our direct costs to finish out the job was still $40,000, right? This looks a lot like the one that we had over here in March, 35. Our overhead, $5,000, and our net profit of $30,000. So this is kind of what I call the QuickBooks method, right? This is when we don't have a work in progress schedule. We haven't matched up our recognized revenue to our earned revenue. If we actually published financial statements, our recognized revenue would have been 75, 0, and 75 respectively. And that's obviously causing some pretty wild swings going on. So we need to do something called adjust this for our over or under billings. How do we do that? Well, we mentioned up top that we're going to match this to our earned revenue. Earned revenue is when we follow the cost curve, but we make it end up at the top of the revenue line. So we would draw a fake line here that starts at the bottom and follows the cost curve. So it has the same slope-ish as the cost curve here, but ends up at $150,000. This is our earned revenue line. And then we can calculate how much have we earned in this period. Well, earned revenue is a calculation that actually takes our percent complete and it multiplies it by our total revenue, right? And so how do we get our percent complete? We basically just say our cost, $40,000 divided by our total cost, right? So we're going to say $40,000 divided by 120, right? That's going to be 33% complete. We're going to multiply that by 120 and 150, if I can do this right, 150, this number here. And we're going to say that our earned revenue is going to be $50,000. That means that this line right here, where it intersects the end of March 31st, is $50,000. Earned revenue for the end of March is $50,000. Okay, well, we've billed $75,000, but we've only earned 50. So this gap is called an overbilling. This is an overbilling of $25,000. We've billed more than we've earned, $25,000 worth. Well, we can keep going and look at the end of April, see what this job has done at the end of April. Again, our percent complete is going to be a pretty easy calculation. We're going to take our total, 80,000, right? 80 divided by 120. We're going to get to 67% here. 67% complete. We're going to multiply that by our revenue of 150 over here, and we're going to get our earned revenue of $100,000. So now this line intersects the end of April or April 30th at 100. How much have we billed? Well, it turns out we've only billed $75,000 still because we didn't bill anything in April. And in this case, we have an underbilling of $25,000. In month number 1 in March, we had an overbilling of $25,000. Now in April, we have an underbilling of $25,000. And at the end of May, what's going to happen? Well, this line is going to be exactly on that line. We're going to have an over underbilling of 0. So what do we do with this? Well, what we have to do down here on our P&L is we have to adjust for this. So in the first time we overbilled $25,000. That means that we have to subtract out our $25,000 from that month, and we have to loan it. So this overbilling subtracts out here, and we're going to loan it to this month plus $25,000 here. Okay, so what does that mean for our total revenue for March? It's 75 minus 25. That means that we get $50,000 of revenue, not billings, and that means that our gross profit drops to $10,000, and it means that our net profit drops down to 5. So we went from 30 to 5. What happens the next month? So we loaned this 25 to the following month through the overbilling. Now we have an underbilling of $25,000. That means that our billings amounts was $25,000 less than they should have been. So we have to take this and we have to give it to this month plus $25,000, and we have to borrow it from the next month, negative $25,000. You never do it in a single month. You always do it in 2 months, which we'll talk about in detail in a bit. Here, now we can do the same math again. 0 plus 25 that was loaned from the previous month, and loaned from the previous month, and from the one that was borrowed from the next month. So we get a total of $50,000. Whoops, I'm lost my colors here. $50,000 of revenue. We have our gross profit of $10,000, and we have our net profit of $5,000. So we went from our, forgot the number now, negative 45 to 5. Similarly, the last month, we just do the math here, right? Our revenue is 50, and we get a gross profit of 10. We had 30 previously. Now we take 10 minus 5. We have our net profit of 5. So what has happened here? In March, in April, and in May, we've just smoothed out our financial statements so that we have net profit of 5,000 plus 5,000 plus 5,000. Now, I mean, the totals add up the same, right? 15,000 here, 15,000 here. But the financial statements are nonsense before we do this earned revenue calculation. In March, it looks like we're making bank. In April, the owners are panicking and laying everybody off. Consolidation, selling off their brand new bought truck that they bought at the end of March when they thought they were doing great, right? And at the we have this kind of whipsaw effect, right, where we're just going back and forth. Earned revenue smooths all that out and says we get only the earned revenue on the profit and loss. And if you're a project manager here and you're going, Michael, I'm a project manager, I don't care about the P&L. Well, believe me, your boss cares about the P&L. And believe me, if your boss cares about something, it's in your best interest to care about it too. All right. So let's go through some of the terms and define them. I've already used them here, but we're going to talk about those and some additional ones that are really important to know. First of all, we have what is called the original contract amount. This is the amount at bid expected to bill on the job. Then we have what is known as the current contract amount. And this is simply the original contract amount plus change orders. The original contract amount plus change orders. Next term is our build to date. This is the sum total of how much you've billed on the job. So our build to date, if we would go back up to our graph here, it's getting a little bit messy at this point, was $75,000 as of the end of March. It was also $75,000 at the end of April. Finally, at the end of May is when it jumped up to $150,000. So our build to date is how much has been billed on the job total, cumulative amount. Then our last one is our projected revenue. And our projected revenue is the amount that the project, our project manager expects to bill at the end. I can already hear at the end of the job. I can already hear you asking, wait a minute, why would that be any different than the contract amount? Well, the difference is that the project manager might know stuff about the job that you don't know. This is especially true about unit-based billings. So sometimes there isn't a formal change order that's going to come, but you're going to have a unit billing. This happens on Department of Transportation projects all the time, where potentially something like a roadway excavation or some other line item is going to overrun or underrun. You can have flagging hours that overrun or underrun, and those won't necessarily trigger a formal change order, but it will change the amount of revenue that you expect to receive for that project. So the project manager will know some of that and can project that revenue in there. They can also know about unsigned but expected change orders. Now you have to be a little bit careful here, because if you have an overly optimistic project manager that thinks that they're going to be able to get away with the moon, and it might not actually be the case that they will be able to. In many cases, people say that if they're unsigned project change orders, then we just leave them out of the projected revenue. That is an internal decision. Generally that's a conservative way to go. So we have similar things on the cost side, right? We have original estimated cost. Original estimated cost. Our original estimated cost is cost expected at bid. And just like above, we have our current estimated cost, which is simply our original cost plus change orders. Sorry, that was not supposed to be a G. Change orders. Right? This is the cost of the change orders. They asked us to do additional work. They asked us to change out the light fixtures. They asked for more expensive ones, whatever it happens to be. There might have been revenue associated with that we sent to the owner, but there was also costs associated with that. Maybe additional materials cost, maybe additional labor cost. This would also be change of conditions, right? Maybe you're an excavation company and you just hit an abandoned steam pipe that wasn't in the plans. Okay, what do we do with this, right? Okay. We then have our cost to date, also known as actual cost, and this is just the cumulative cost that you've accumulated on your job. Cumulative cost. I've never figured out why cumulative is both a cost and a cloud. All right, cumulative cost on the job to date. If we go back up to our messy graph up above, we're going to see our cumulative cost at this time was $40,000, and at this time was $80,000, right? It accumulated over the course of the job. Finally, at the end of the job, our cumulative cost or cost to date was 120 at the end of May. Okay. Finally, we're going to have our projected cost. Our projected cost is the the project manager's estimate of cost at completion. This is the most important one of all of these. Project manager has to come in and say how much does he expect to spend at the end of the job. This is where all the risk is for construction companies. How much are you going to spend to finish this job out? And every month you need to be looking at your cost, and every month you need to make a more accurate estimate of how much you're going to spend. So in the case up above, we said it was $120,000 we were going to spend no matter what. But of course, that is not actually what happens in real life. As the job progresses, there's going to be some places where you get the job done with better productivity than what you bid. There's going to be some cases where you get it with worse productivity than what you bid. And as a project manager, you need to be the one who's in control of that, who's understanding what's actually happening and putting that down on paper. Then we get our three terms as they relate to the over/under billings process specifically. The first one is percent complete. And this is generally calculated by taking our cost as our numerator and dividing it by our projected cost. I'm sorry, let me rephrase this. Our actual cost to date, divided by our projected cost in order to get a percent. So it's a calculated term here to get our percent complete. Then we have our earned revenue. And our earned revenue, like we talked about before, simply takes our percent complete and it multiplies it by our projected revenue. And this gets us our earned revenue. Finally, we have our over/under billings number. Over or under billings. This takes our earned revenue from the previous calculation and subtracts out our amount billed. It's the difference between our earned revenue and our amount billed. Over or under billings. So armed with those terms now, we get to go in and look at what you'll typically see on a work in progress schedule. So you guys are here because you use Vista, or at least most likely you're here because you use Vista. And what's interesting is that so far all I've done is shown you whiteboards, which is way more fun than showing you Vista because Vista looks boring and dumb and stupid. It's actually not boring and dumb and stupid. For one thing, it has much better handwriting than I do. It does all of the math for us. But what I found is that I want to describe how it's doing the math in some detail, because like anything, we can put garbage in and expect diamonds out, but we'll be sadly disappointed. We actually need to be able to understand what's happening so that when we're getting garbage out, we can go in and find the mistakes and fix them. So this next little bit here is showing you the work in progress schedule. Typically, the one I use is the JC work in progress with overrides report inside of Vista. That's just JC reports, JC work in progress with overrides. That one is a very simple report that looks a lot like the one I'm going to draw out here on the whiteboard. But there's other ones in there as well that do all of the same thing. They use these same calculations as percent complete to get our earned revenue. So let's look at a couple of jobs. So I took this from these were real jobs a few years ago that I got permission to use. I just rounded to the nearest thousand to make our life easier here. And I'm going to show you a couple of jobs that of a real live company over a couple of months. We're going to talk through how we are going to get our earned revenue number and what this work in progress schedule that I'm about to draw is going to teach us. So let's pretend that in March, our company had two jobs, right? And we'll just call it alpha and beta, right? So we sat our project managers down and we said, hey, project managers, can you please give us the projected revenue on your jobs? So the two project managers gave us their projected revenue numbers. On alpha, the projected revenue at the end of the job was $435,000, and on beta it was $343,000. Then we looked inside of the accounting system and we said, well, what is our bill to date? Bill to date. And our bill to date on alpha was $150,000. On beta, it was 0. Then we said, well, how much, Mr. Project Managers, do you expect to spend at the end of the job? That is, what is your projected cost at the end of the job? Our projected cost at the end of the job, said the Alpha Project Manager, is going to be $391,000. Now, we could pull out a quick calculator and we could say, all right, if you're going to have 435,000 of revenue and you're going to spend 391,000, you're going to have $44,000 of job profit, which means that I could divide this by 435 and we could see that we are at a 10% or just over 10% margin on the job, right? That's pretty good information to know. Is that what we bid it at? Did we bid it at 10% margin? Is it coming in higher, coming in lower? We don't know from the information we're given here. Then we can, we asked the beta project manager, how much do you expect to spend? He says $312,000. Okay, $312,000. Then we look in the accounting system and we can see what our cost to date is on these two jobs. And on alpha, we spent $167,000. And on beta, we spent $110,000. Okay. Well, the first thing we have to do in order to calculate our over under billings on each of these jobs is we have to calculate our percent complete. That percent complete will allow us to calculate our earned revenue, which will then allow us to look at our billing number. So percent complete. Percent complete. If this was a live classroom, I would be picking on somebody here, probably you, Jonathan, to tell me how to calculate percent complete. But in this case, I'll just give you the answer. And the percent complete is calculated by getting our cost to date, 167, divided by our 391, I'm sorry. I'm a little dyslexic here. So we're going to take our cost to date, 167, and we're going to divide by 391. And we're going to see that we're 42.7 or 43% complete on that job. 43% complete. And the next job down, we would do the same thing, right? We take our 110,000 and we divide it by our projected of 312, and we get 35%. Again, we took 110,000 and we divide it by 312, and we get our 35%. So we're 35% complete with the beta job, and we're 43% done with our alpha job. All right, now we can calculate our earned revenue. And again, I'd probably be asking you, Dennis, if I was in person, how to calculate earned revenue, but you're lucky because I'm just going to give it to you. We're going to take our percent complete, and we're going to multiply our percent complete by our projected revenue. So we're going to take our percent complete, and we're going to multiply it by our projected revenue, and we're going to get our earned revenue, just like we did before. So in this case, 43% of $435,000. Let's do the math here. I'll take my exact number since I have it from before, very close to exact. Wow, maybe not. This is why you have to be careful with your digits here. All right, times $435,000. 185,792, or I'll round up to 793. Okay. So 185,793. And the other one, 35,000 times 343, I could do the same thing, but I'll just tell you it's 120,929. Next, we have to calculate our over or under billing. So in the first case, we can see that we've earned $185,000 in alpha, and we've billed 150. Well, we've earned more than we've billed, which means we're underbilled. I usually like to show underbillings as a negative number, or underbilled by $35,000. Underbilled by $35,793. In the second case, we've earned 120 in the beta job. We billed 0. And so our underbilling is the full amount of our earned revenue, negative 120,929. So that means that our total underbilling for the company is 156,722. So let's take a step back here and look at what we're seeing on alpha and beta. So first of all, we don't have all the information here to make all of the necessary analysis for whether alpha project manager and beta project manager are doing their jobs correctly. For one thing, although we calculated that alpha was 10% profit, we don't have what the original contract amount was here, so we're not exactly sure whether they're doing better or worse than originally bid. That's an important piece to understand if we have the to know whether or not the project manager is doing well. But another piece is, are the billings actually keeping up with the project? And you can see that in both cases, the billings are not keeping up. We are underbilled in both cases. And in beta case, we're significantly underbilled. As the person reviewing the WIP, you need to jump on these projects that are significantly underbilled and ask the project manager what's going on. In many cases, the projects are underbilled because of change orders that are not signed, but the work has been completed. They're underbilled because of change orders that have been signed, but the work has actually been completed. You've spent the money. It's in the cost to date. The actual cost, the percent complete has gone up, and you do not have any bills to show for it. That means that you're funding the project on your own dime. And also that money is at risk. You may never actually see that money. So we can see right off the bat that we have a potential problem with both projects and a significant problem with the beta project. So then we get to post this, and we're going to post this in a very specific way. And in order to show this to you, unfortunately, I have to dive just slightly into accounting and accounting theory. So let's take a little break here from normal math where we have positives and negatives. And let's dive for a second into the world of math where we only have debits and credits. Because back in the day, 2 years, in fact, after Columbus sailed the ocean blue, Luca Pacioli, if I'm saying his name right, I'm sorry, but my 15th century Italian isn't very good, created what is known as the double entry accounting system. And the double entry accounting system basically said that for every time you enter something in one side, you have to enter it in another. That there's always, the money never just appears out of nowhere, but it always comes from somewhere and goes to somewhere, right? There's always two entries. And he called those, because he spoke Latin, debit and credit, or the Latin derivatives thereof, debere and creditare, or something like that. I don't speak 15th century Latin any better than I speak 15th century Italian. And he was the one who outlined in a book on mathematics the idea that we have to have a balance sheet that shows us how much assets we have, that is what we expect to have in cash in the future, our liabilities, and that it comes out to our equity, right? The old accounting equation, it's called a balance sheet because assets equal liabilities minus owner's equity. And also through his double entry accounting system, we were able to create the P&L like we talked about before, with our revenues at the top, less our direct costs, which gets our gross profit, less our overhead costs, which gets us our net profit at the end. He was also the one to define where the normal balances are. So a normal balance basically says, well, let's see if I can spell balance right. Apparently I don't speak 21st century English either. The normal balance of all of these accounts. And he said that on some of these ones are going to end up on the left side, and we're going to call those debits. And some of them are going to end up on the right side, and we're going to call them credits. For those of you who are accountants in the room and know this way better than I ever will, I apologize. Just bear with me. This would be a good time to go get yourself a cup of coffee. Our normal balance just says that normally these accounts will have either a debit balance or a credit balance. In the asset case, he assigned them to debits, liabilities, he assigned to credits, owner's equity, he assigned to credits, owner's equity, then down as it pertains to the income statement, he assigned revenues to credits. He assigned all expenses, whether they were direct costs or overhead costs, debits. And that allows us to create these two financial statements. Okay. Well, when we talked about our over under billings before, we talked about the fact that we're going to be increasing our revenue or decreasing our revenue. So this amount here is going to directly impact our revenue number. But because this is double entry accounting, we actually don't get to only impact revenue on its own. That would be if you guys were engineers. You could do negatives and positives. You're accountants now, and you actually have to do debits and credits instead. So because of this, since we can't just affect our revenue accounts, we also have to affect something else. And in the case of over under billings, we're going to be affecting our assets and our liabilities. So in the case of this $156,000, we can see that we only billed 150, and yet we were supposed to have billed a total of, what's 185 plus 120? I guess I can do the math here on my other screen. 306. 722. So our total billings was 150, and our earned revenue what we should have billed if we'd gone based on earned revenue was 306. The difference was that 156,000. So if we looked at our P&L here, we're going to already have in this P&L revenue or billings. I guess I can say billings of 150, and we need to add to this the 156 to get our total earned revenue of 306. So we're going to be increasing our revenue, or if we're going to increase something with a normal credit balance, that means that we're going to credit it. We're going to credit that account. So this is called a T-chart here. We're going to say our revenue account is just going to be, we'll call it 4,500. And we're going to have our debits on this side and credits on the other side. We're going to increase this by $156,000, 156,722. But in order to make this a complete transaction, we also have to debit something in the equal amount. So we already know that we're going to debit something for 156,722. But what is it that we're going to debit? Well, it turns out that what we're going to debit is an asset. That the other side of this is an asset called cost in excess of billings. Cost in excess of billings. Now I can see some of you already scratching your head going, wait a minute here, Michael. So we're underbilled, that's a bad thing. How can we get an asset out of this if it's a bad thing? Well, it is a bad thing because you always want to bill. You want that to be cash in the bank as soon as possible. And so from a project perspective, it is a bad thing. But why? The reason it's an asset is because from an accounting perspective, we expect to receive this $156,000. It's a true asset. This money will be coming in the future, and we've earned it now. The other $150,000, that's sitting in our accounts receivable. That's already an asset. That money's going to be coming in because we've billed them. This is an asset of lower quality, you might say, a low-grade asset called cost in excess of billings. It's saying that, hey, we're going to be able to bill for this. We just haven't quite got around to it. It's a true asset. And cost in excess of billings, it's going to be something like an asset with maybe a number of 1,700 or something like that, depending on your guys' chart of accounts. So we're actually going to do double entry accounting to post this. Pretty straightforward. And then we're going to reverse this the following month. So in the following month, we're basically going to just reverse this out by debiting 156,722 out of that account and 156,722 out of that credit account. That will start the month out with a zero balance in our cost in excess of billings account, and it will it'll have the cumulative effect of the year to date in the 4,500 account. So we have a company with alpha and beta jobs. With our projected revenue, our bill to date, our projected cost, our cost to date, we calculated our percent complete. We calculated our earned revenue. We got our over under billings number. Then we turned this into accounting speak, right? We increased our asset. because we're going to get this money in the future, and we increased our revenue because this is earned revenue in the current period. And by doing that, by increasing our revenue, we modified our profit and loss statement so that it's readable and valuable for the owners. So let's go through and do a little exercise that is similar to this, but it's the next month in alpha and beta. The next month in alpha and beta. So we said this was March. Now we've chugged forward a full month, and the project managers of alpha and beta have sat down and have been asked to do this same job again. Well, something has gone wrong with beta. So let's look at them in turn. All right, we have alpha and we have beta. First, we ask them to do our projected revenue. Projected revenue has climbed slightly, 437. We got a small change order on that one. Projected revenue has climbed slightly on beta, $345,000. Billings to date. Now on alpha, we've billed $281,000. Beta still zero. Cost to date. I'm sorry, projected cost. Projected cost. Alpha is still chugging along, $247,000. Projected cost. Whoops, I said that wrong. I wrote down the wrong one again. I'm looking at the wrong column. $395,000. Still chugging along, roughly 10%. On the beta job, however, the projected cost is now $345,000. And even somebody that can't do math in their head, that was born with a silver calculator in their mouth like me, can see that if you're spending $345,000 and you expect to earn $345,000, that you're not making a lot of margin on this job. That's roughly zero if you round to the nearest tenth. And so we have a problem on this job. Well, our actual cost, if we looked at our accounting system, our cost to date is $247,000 on this job and $164,000 on that job. So beta has a problem, right? 0% margin. And before we were something at like 10% margin. So we do the same math as we did before, right? Our percent complete, and we would take our actual cost and divide it by our projected cost. We get to 63% here, 63% complete on that job, and 48% complete on that job. We can do our earned revenue calculation, earned revenue. And in this case, I probably would be asking you, Lars, what the earned revenue is, but it's actually 63% times our projected revenue. In this case, I'll just give it to you. It's $273,000, 263. And the beta comes out to $164,000. Then we can calculate our over under billing number, right? Over under billing. In this case, we earned 273. We actually billed 281, so we're slightly overbilled. We have a positive $77,737. In this case, we've earned 164. In Beta's case, we've billed zero. We have underbilling of $164,000. Major problems. And now, when we do this debit and credit, we're actually going to add another account here. called a liability account. Let's just call it 2,700. And this one is going to be our billings in excess of cost. That is that because this is a liability, because if we were to shut down the job right now, we would actually have to give this money back. Because we've overbilled. We've billed in advance of when we've got the job done. But the process is the same, right? So this was March. In April, now we're going to take our sum total of our over under billing here, right? 164 less 737. It's going to be 156,263, and we're going to increase our revenue by 156,263. Right? That means that we're going to credit it 156,263. The reason we're crediting it, to those of you who were either accountants from way back or astute and were paying attention, it's because our revenue has a normal credit balance. So we have to credit here in order to increase it in April. Now, our billings in excess of cost is actually going to be 7,000. So we're actually going to take this and we're going to increase this liability here, 7,737. And we're going to take our 164 and we're going to increase our asset by 164. So we actually split our assets from our liabilities per job when we do that. And so then we would be able to calculate our profit and loss that way. You can see here, this right here, where we reverse this, where we're taking a revenue and we're putting it in a current month and taking it out of a future month. What we're doing is we're borrowing it from the future. We're borrowing this revenue from the future. We're saying, hey, April, by the way, I actually earned this revenue. Give it to me. And we're borrowing it from April and putting it into March, even though we didn't bill it. But there's something else that's happening that is really, really fascinating when we look at this, and it gets really complicated mathematically. I'm not going to go through all of the math here, but I want you guys to understand the concept. And we're going to take a look at beta and how this works with particularly the beta job. Because what remember up here, beta's project manager told us that we were going to spend $312,000 to finish this job. But then, as the job wore on and he didn't bill, it turns out it was actually going to be $345,000. So what happens? What happens to this when we do this? Well, in order to illustrate this with beta, I'm going to draw a bar chart. We're going to put money here. We're going to put March in one bar, and we're going to put April in this chart. Okay? And we're going to split March into two and April into April will go ahead and split into two if we have to. So we're going to say March projection here. What happened? Well, in March, we had our cost to date of $110,000. And then we calculated our earned revenue for the beta job of 120. Okay, so our earned revenue number was $120,000. Right? And our billings was 0. Therefore, our under billings, we were under by 120,000. Okay, that's what happened in March. That's what we used when we calculated March. Well, when we calculated our April, our project manager gave us a new projection, right? So April we had a total of 164 actual cost, right? So 164 minus 110. That means that in April, we had $54,000 of actual cost. Because remember, cost to date is showing our cumulative. This is our this number was our actual cost, which included our previous month's cost. Right? And we had our earned revenue of $64,000. $164,000, of which 120 had been earned previously. That means our earned revenue, so we take our total 164, total earned to date, we subtract out what was earned previously, and we're going to get $44,000, right? Our earned revenue is $44,000. Wait a minute. What just happened here? How can our earned revenue for April be less than our actual cost for April? Well, the reason is that when we earned our revenue, this assumed a roughly 10% margin. It assumed a roughly 10% margin. But we were wrong, or more specifically, the project manager on beta was wrong. And if we had done the projection accurately, what would have happened is the actual cost for March would have still been $110,000. But when we did all the math, the earned revenue would have come in at exactly $110,000 as well, because it's a 0% margin on this job. Unfortunately, we used this 10K, not 0. And since we did that, now the month is closed. We've delivered the financial statements. We've sent them out. People have partied. And we have to do something about it. And the only thing we can do about it is we can say mea culpa. I think that's another Latin phrase from the 1500s, that this 10K that we took previously, we're going to subtract out of the next month. We're going to drop our earned revenue by $10,000 because we earned it too early. So as project managers, it's extremely important that you give us accurate projections, and that if you're going to err on your projections, that you err in the early months on the side of caution. You're being conservative. We would much rather have this go the other way, where in future months we said, we earned too little, please give us more money. But unfortunately, this is the way it often goes. So in the second month here in April, only because of a projection change from a margin going from 10%, 10% in March to 0% in April. We lost $10,000 in April. This can have serious and very confusing effects on your profit and loss, especially when you're nearly complete with a very large job and the margin drops. Single-digit percentage drops on a single project can dramatically affect your P&L if that project is almost done, if you've over-earned your revenue in previous months. Okay, well, that was a lot of fire hose there for you guys to drink out of. So I'm going to run through and just review what we've learned. First thing that we learned way back up here You guys remember this far back? Was that our accounting method here is to match up recognized revenue with earned revenue. Now we've seen how that happens. Our recognized revenue, that is what is on our income statement or profit and loss, is equal to the earned revenue. Our earned revenue being the percent complete multiplied by how much revenue we expect at the end. We're using cost to get that percent complete. Why are we doing this? We're doing this because it forces the project managers to look at their jobs and prove they understand the financials of their jobs. We're saying, Mr. Project Manager, Mrs. Project Manager, please tell me how much you expect to spend at the end of the job. Please tell me how much you expect to bill the customer at the end of the job. Those projected numbers, because I need them for my formulas. And more importantly, because I need to know you're making money. It also provides readable and valuable financial statements to the owners, right? Remember when we had that QuickBooks style non-WIP P&L, and everybody in 1 month the owner was buying a yacht, and the next month he was laying everybody off? We don't like that. We want to have everything be nice and smooth. And finally, it allows us to have GAAP financial statements. We talked about this. That has subsequently got very messy, where we drew that blue line that followed the red line, followed the cost curve up to the top of the projected revenue. This allows us to calculate our projected revenue, projected our earned revenue, and adjust our billings down or up based on over or under billings. We drew that out. We showed how the margin changes, especially the net profit here from negative, we have 30, negative 45, and 30 to 5, 5, and 5. And then we went through our contracts, our terminology for our contract, current contract versus current, original versus current. Then we talked about our bill to date and our projected revenue. We said the same thing for our original estimated cost, with our current estimated cost being the difference between our original and change orders, cost to date, and projected cost. And then we talked about the 3 terms that we have to calculate: percent complete, earned revenue, and over under billings. And of course, in Vista, these 3 things are going to be calculated for us: our percent complete, our earned revenue, our over under billings. They're actually going to do the math for us. We don't have to whip out a calculator. We don't have to type it into Excel. We don't have to do anything on our abacus. But we do need to know how it's calculating it, because if it's giving you some kind of crazy number, it's best to know what's going on behind it. And then we went through this detail here for alpha and beta projects, and we talked about how it affects the balance sheet and the profit and loss, and we talked about the normal balances of the various accounts, so that you can calculate that. Finally, we talked about what happens when a projection changes, and you can see here that in the beta case, that since we over accrued our revenue to the tune of $10,000, we had to give that back to April. We had to drop April's revenue down by $10,000 just to because we over accrued it in the earlier month. Okay, and that's it. Thank you, guys. That's a lot to take in, but I'm going to open it up for questions, guys. And feel free to ask questions all over the map, including how we do this in Vista or anything like that. Any questions? I'm going to look at chat too, in case someone's going to chat in there. Nothing yet. It's Sharon says, I left them all in stunned silence. Well, that might be because I taught you guys so quickly that you can't think of any questions yet, and you're just sitting there scratching your heads. That'd be the bummer. One thing I can say is it would be really good for you, for those of you who are already running a WIP, and I hope all of you are, to go and, especially if you inherited someone else's WIP inside of Vista, that that you go into Vista, run the WIP for the previous month and go through the calculations. Look at the projected cost, look at the actual cost, do the percent complete calculation with a calculator. Probably not an abacus, but I mean, if you're good at it, I guess. But look at that and do the math and see kind of how that plays out. It really solidifies things when you do it with projects you're familiar with. Huh, I like a good T chart too, Tracy. Color-coded bar charts. Yes, absolutely. The I try to keep my colors aligned, but sometimes I forget. Well, unless there's any other questions, then I'll let you guys all go. And if you have any follow-up questions after the stunned silence is over, you can always feel free and email me, and I'll try to get back to you as soon as I can. Thank you, Kay. Yeah, and thank you all for being here. It's always good to see you. All right. Thank you all.